The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Welcome to the Ask the Expert show on W4CY Radio and Talk4 TV, where we bring you educational information from top local experts in the fields of legal, health, financial, and home improvement. Now sit back and listen to experts in family law, association law, hearing loss, business brokers, home care, along with many other topics. Now here are your hosts, Steve-O and Sophia.
Hey, good morning. Welcome to another Ask the Expert show. I am your host, Steve-O, and we are going to be talking about wealth management today. You know, we get numbers of how many listeners, how many viewers we have, and we've got incredible numbers. But it's amazing when we receive your emails. It really just, hey, we have got an amazing audience out there. And I bring that up because 90% of our emails over the last, I'd say 4 months, have involved money, which our next expert is an expert in. And they all ask the same question, which I'm going to ask our expert, our guest, next after I introduce him. Good morning, Alvin Clay. Alvin Clay Financial Advisors.
Good morning, Steve. How are you?
Doing well. Good to see you. Alvin, this is the top of everybody's mind, is the economy. And we've received, in fact, not just in the Philadelphia area, but throughout Pennsylvania, we have gotten emails and texts, phone calls. People are very concerned about the economy. But what most of the emails say, Alvin, is I keep hearing the economy is getting better, but I go to the grocery store, I go to the drive-up window, I go to the gas station, and it tells me it is costing me so much more to live. People are concerned, Alvin.
I think we all have our own political views, and I think it's a shame sometimes. And I won't give you my political views; you could probably guess them anyway. But when it's rare that you can get someone to talk about it and not somehow politicize it. So the people who are in office will try to tell you it's great, and the people that are not in office and want to be tell you that it's terrible. And it's always been the case. So where do you get the truth? I guess it really depends on where you're coming from and how it's affecting your life. And the issue that first of all, everyone's been waiting for the recession, right? And I heard somebody call it's the Godot recession, where it's like you're waiting and waiting, and is it going to hit? And now the experts are about 50-50 as to whether we're going to have one. And even if you do have one, some will disagree that you have one because they'll change the definition to fit their own needs. But one thing for sure is that the economy is not growing very fast. It's sluggish at best. A lot of economists think we're going to have sort of a soft landing, that we might not have a deep recession, but you might have very slow growth for a while. But for most people, they say, Al, I don't know how that affects me. Well, the biggest issue that most people are faced with right now, flat out, is inflation. And even though wages have risen, they haven't risen as much as inflation. So, if you get a 5% raise and the prices of things are up 7%, well, you lost money.
Yes.
And that's what people are feeling. And it depends on what it is they have to buy. For example, if your largest expense is your mortgage and you have a fixed rate mortgage and you refinanced at 2.5%, inflation's not affecting what you have to pay out every month. So you don't feel it necessarily. But if you pay rent, well, those rents are going up, and they're really going up. So it affects you, the renter, more than it affects the person with the mortgage. And certainly gas prices, well, they've gone way up, they back down again, but it's still pretty expensive, and that affects, frankly, the low wage earner the most. I mean, the people who are feeling it the most are the people who live paycheck to paycheck. And they go to the grocery store. I mean, we all go to the grocery store, and it's like, oh my gosh,
Right.
I've done that where I've picked something up.
It doesn't matter if you have a D or an R in front of your name when
right.
you go to the grocery store.
Yeah, I've picked up things at the grocery store and looked at the price and just put it back down. It's like, I'm not going to pay that for that. I'll do without, or I'll get something else. And we're all feeling that a little bit. So, hopefully it'll turn around. I mean, the answer to all of it is a growing economy, and whatever policies you think will be good for a growing economy, that's how you should vote in terms of economic. And there are differences of opinion as to what will work, but
you know what, Alvin, and I do not want to make this a political show, but to me, if the other side can show me some improvement, hey, I'm all for it, whatever the other side is. But is scaring people. This is the letters we're getting coming about your show. People who watch or listen to your show, is people are scared. And they don't care about politics.
No, so what the way it comes down to, I'm not an economist, and I have a TV behind me that's usually on that has the financial shows on, and you'll have one guest on that says one thing, the other says the other thing. They pit them against each other. I don't know what's going to happen to the economy, but
no crystal ball.
No, I don't. Which is why when we manage money for people, we do it in such a way to insulate them as much as possible from these variations, so that you have a really good idea of how much money they're going to need out of their investments in the next 3 to 5 years, and you invest that differently than you would their long-term money, so that you don't know what's going to happen in the economy. And because you don't look, if I knew the stock market was going to go up 15% in the year 2023, I'd put everything in stocks.
Yes, right.
But I don't know that.
That's right.
All I know is long-term averages, and so you set it up in such a way to mitigate these variations that are sure to happen, and that's what we do for people, so that frankly they feel better about it. They can sleep at night. They can take some of that anxiety away. I can't take all of their anxiety away. I don't have I don't have a pill mill here.
Right.
But at least have them understand the risk that they're taking or not taking.
Alvin, is it harder to manage money now than it was, say, 3 years ago, 4 years ago?
Well, I don't think so, because I don't change. There's an overriding philosophy as to how you go about it, and it is matching how you invest the money with the risk and the timeline for the client. And if you consistently do that and say, this is your short-term money, this is your long-term money, this is your mid-term money, that doesn't that doesn't change. The client's circumstances might change, and you have to adjust, because what was once long term is no longer long term. It might be short term, so you need to adjust. But I don't think it's that difficult. I don't get involved in what's happening on a daily basis in the markets. I see it. I see the I watch it. It makes a difference. To me, look, I collect my fees based on the value of the assets that I manage. I get paid 4 times a year. So what the markets are on March 31st, June 30th, September 30th, and December 31st makes a difference to me. You only get paid 4 times a year. You pay attention to that. But
Right.
it doesn't really affect how we advise our clients. And I don't think my job is to make it simple. I can't, it's not that complicated. There are complicated things behind it. Like today, we were going to talk about IRA accounts. They can get extremely complicated. But there's simple ways of explaining those things. At some level, these things, everyone can understand them.
Well, I started to show off I wanted to address, because we have received so much mail regarding this subject. Tell people about Alvin Clay Financial Advisors.
I am a registered investment advisor. I am not a stockbroker. I'm not an insurance broker. I don't sell investment products for a commission. I sell advice, basically. And I explain how we get paid. Well, I can get paid a financial planning fee as well, but mostly what I get paid is on the value of the account, and what comes with it is financial planning advice, year-round advice for people. Call it a retainer. So people come in here and we learn all about them. We do a lifetime forecast of what's coming in and what's going out. And then we look at what they have and what they owe, their loans, their estate documents, their wills, the trust, their insurance policies, look at everything else, and then say, let's come up with a plan as to how you should be investing your money. And then we monitor it. And then we're here year round. If they call for, the big things, we're thinking of buying a vacation home, or I don't know whether to buy or lease this car. Or, it could be, where my kid decided to go to medical school, or there's a lot of things that can happen, and we're here year round for them. And that's all covered in the fee that they pay for us managing their assets. And, I'm a CPA, I have a master of tax, I'm a certified financial planner. I've been CEO of larger companies that do this for affluent people. And I love every minute of it.
It's so obvious, and you're so good at what you do. Let's start off with basics. This show is an educational show, and we just so happen to have the finest financial advisor. Let's start off. We just brought it up about IRAs. What is an IRA?
Well, I just gave a caveat. These things can get extremely complex. So anything that I say in here, if you want to do something, you need to call somebody first before you do it. Don't just take it here. But in its simplest form, it's IRA is not the Irish Republican Army. It's not what we're talking.
Yes.
It's the individual retirement account, which it's exactly what it says it is. It's owned by an individual, you, not you and your spouse. Not you and your fellow employees or anything. It's you have your own account, and its purpose is to accumulate retirement assets. And it's an account that has special tax advantages that the government put in there to encourage you to save for your own retirement. And they were put in place because too many people were relying only on Social Security, which is rarely enough. Social Security was meant to be supplemental, not to pay for everything. Also, they've become increasingly important with the traditional pension plan having gone away for the most part. There's still some that are out there, but they're not that. So it's a retirement account that you own, and it can be opened at a bank, at a brokerage firm, at a trust company, a registered investment advisor like me who uses an outside custodian to hold those assets, and they essentially are there are rules that we have to follow in accounting for them, but it's but you do have to go to a bank or a brokerage firm or a trust company or something to open it up. So that's what it. And there's more to it that I'll get to.
Well, Alvin, who can contribute to an IRA?
So big picture, because it gets really complicated, but big picture is this: anyone who has earned income can contribute to an IRA. Anyone who has earned income, no matter how much you earn, if it's a traditional IRA, you can earn $1 million a year and you're not precluded from contributing to an IRA. However, you may not be able to get a tax deduction for what you contribute. So the simple answer is anyone who has earned income can contribute to an IRA. And if your spouse has earned income, so let's say there's a spouse that's not working and a spouse that is working, they both can have an IRA account based on the working spouse's earned income. So now there are a lot of rules. If then there are different types of IRAs. How much you can deduct from your taxes, from your taxable income in the year that you put it in, depends on a few things. For example, if you or your spouse are covered by a pension plan at work, you might be limited as to how much that you put into an IRA that you can deduct. If neither of you are covered by a pension plan at work, you'll be able to deduct the whole thing that you contribute. So the thing to remember is this: anyone can put the money in. Not everyone can deduct it. Whether you can deduct it or not depends on some things like whether you're covered under a plan at work and how much you earn. And I'm not going to get into those numbers because everybody will forget them anyway. But there's the question, if I want to start an IRA, how much can I put in? And how much can you put in is based on your earned income. And it's now $6,500 a year per person. And if you're over 50, you can put another $1,000 in. That's a catch up. So you can put $7,500. So husband and wife can put $15,000 into an IRA. There are two.
Do you like IRAs, Alvin?
Well, they've become. I never would have thought this, but they're probably we manage about $100 million of assets here, and about half of it is in IRA accounts.
Wow.
Almost everybody who comes here, we open up an IRA account and a investment account, and maybe some other sort of accounts. But IRAs are wonderful, and they have many twists and turns to them. There's a guy, his name is Ed Slott, who is the national expert in IRAs. I mean, he runs full week seminars for people like me to travel to Chicago and talk about IRAs for a week. Can you imagine anything less exciting?
Wow.
Doing that. But I'm telling you, I mean, there's all sorts of tools and strategies and things, and it can get extremely complicated. But no, they are wonderful. But there are. Look, I'll listen to somebody, and I'll get. Well, we're going to run out of time. So, there are two broadly speaking types of IRAs: are traditional IRAs and Roth IRAs. And I'll be listening to a show like this, maybe on the radio, and somebody will say, you're crazy if you don't have a Roth IRA. Everybody has to have a Roth IRA. Then I'll yell at the radio. I said, no, not everybody has to have a Roth IRA.
Yes.
You
And I'm
know,
aware of Roth IRAs also.
well, they're a wonderful thing, but not everybody would benefit the same way. Some of them, it's not a good idea. So what's the difference? But first of all, Roth, just the term, it comes from Senator Roth, was a senator from Delaware, who's the one that wrote the bill years ago, and that's why it's called a Roth IRA. A traditional IRA, let's say that you meet all the rules for being able to deduct what you put in. You didn't make too much money, you're not covered by a plan at work, so you put $7,500 into a traditional IRA. Well, on your tax return, you'll reduce your taxable income by $7,500. So if your tax bracket is 20%, then you just saved yourself $1,500 of taxes.
Wow.
That year. So that traditional IRA, and then the money is in the IRA, and as it grows over the years, the IRA pays no taxes on it. And then when you start taking it out for retirement, you have to pay tax on the full amount that you take out, which is the original amount you put in for, that you got a tax deduction for, and everything you earned on it in between, you take it out. A Roth IRA, if you put your $15,000, or I said $7,500 for one person, into a Roth IRA, you do not get to reduce your taxable income for that. You still have to pay tax on all of your income. So you save nothing in your taxes that year. However, not only does it grow tax-free over the years, but when it comes time to take it out, you pay no tax on everything that you take out.
Wow.
So the question is it worth paying tax now so that I can get away with not paying tax later? Or am I better off getting a tax deduction now and then paying tax later on? Well, that's different for each person. And when I give talks on this, I one of the things I do, I actually go out to the seminary for the men that are about to be ordained Catholic priests, and they earn a very, very modest living. And I tell them, if somebody is in the lowest tax bracket and has the longest time before retirement, and I say, that's you guys, and you will always be in the lowest tax bracket, put your money into a Roth, because the tax deduction doesn't do much for you now. And then over the, whereas somebody who is in a higher tax bracket and closer to retirement, the deduction for the taxes, for the contribution, makes more sense to them. So, younger, further from retirement, lowest tax bracket, Roth. Older, closest to retirement, higher tax bracket, traditional. And then there's a mushy middle. Sometimes what I tell people is, like, this is flip a coin territory. So why don't we put half of it in the Roth and half of it into a traditional? And we'll know in 20 years which one was the smarter way to go.
Right.
But that's the difference. And one thing that's become very popular is a Roth conversion. So someone has a traditional IRA and they want to convert it to a Roth IRA. And you can do that. So there's a cost to that. Let's say you have, I had a client that did this with a couple $1 million. Okay. You take a couple $1 million out, you have to pay the tax on that couple $1 million now. And then you can put it into the difference into a Roth IRA. And does that make sense for him? Well, we'll see. But we think so, because we think the asset that he owns in that IRA is going to take off in value. And if it does, none of that will be taxed. So, or here's the other way, and this is a couple $1 million. We could have, if you have a person who's in a very low tax bracket, 10%, 12%, take that money out, soak up that low tax bracket, pay the 10 or 12% tax, put the money into a Roth IRA, and that grows tax-free forever for you or your children, your grandchildren, or your heirs. So each person, there's a different strategy. There's the retired person with a 10% tax bracket, or your multimillionaire with a privately held company in his IRA account. They're the same principles, but that you apply them differently. But so that's what a Roth IRA is. In terms of what you can invest in an IRA, how are we doing on time, Steve?
Well, we got 1 minute left. The show goes by so fast.
Well, put it this way: you can invest stocks, bonds, mutual funds. You can do you can't put collectibles into an IRA. You can't put life insurance in an IRA. But there are a lot of things that you can. But traditional assets make more sense. They're less complicated. You start putting limited partnerships and things like that into an IRA, you start running into complications. Like how would you like to find out that your IRA has to pay income taxes? The IRA does. I've had that happen to people. They come in, I put all this stuff in an IRA, and now the government's telling me how to do this. Well, you shouldn't have done that.
Exactly.
So they can get very complicated, but and we'll, on another show, I think we can pick up on some of the nitty gritty details of this stuff.
Exactly. Give everybody your phone number, Alvin.
Well, my phone number is 267-626-2382, 267-626-2382. The website is alvinclay.com, alvinclay.com, Alvin as in the chipmunks, and Clay as in Cassius. alvinclay.com. That's a very dated reference, isn't
it? Alvin's with us every month. He'll be back again next month, second Tuesday of the month. Alvin's always with us, and we'll talk about rollovers and more other things next month when we come back with more Ask the Experts. Alvin, thank you so much. Always good to see you, and thanks for all your great knowledge.
Okay, Steve, talk to you soon.
And we will be back with you next week with more Ask the Experts. Thanks for tuning in, everybody.
Thanks for tuning in today to the Ask the Expert show on W4CY Radio and Talk4 TV. Tune in next week and every week to hear more from our experts on personal injury, insurance, air condition repairs, estate planning, Medicare, and many other topics in the areas of legal, health, financial, and home improvement. See you next week.